From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, August 13th. And why don't we have spooky music to play when we're doing a Macrocast on Friday, August the 13th? But it is Friday, August the 13th. So start off with an ominous start for Secretary Pelosi and Democrats trying to execute the two-step on the infrastructure bill with a letter from 9 moderate House Democrats saying that they were not going to vote on the budget resolution until the infrastructure bill that just cleared the Senate over the weekend is signed into law. And guys, Tony Fratto from Hamilton Place Strategies, John Fagan and Brendan Walsh of Markets Policy Partners here on the Macrocast. I mean, but
it's what we've been kind of saying all the time, where everyone's been focused on the Senate, and the Senate is probably the easy one because you just have to convince two people, Yeah. But the House is unruly, and they only have three seats majority.
So 3 seats swing majority. So this is 9 members. So it seems pretty solid. Then you have a large group of progressives, who say they're not going to take up the infrastructure bill until the social infrastructure bill, the reconciliation bill, is passed. And so it seems like we're at loggerheads in the Congress on spending. Guys, I don't want to spend too much time on this because I know we're going to spend a lot more time on it when we come back. This is just to update Macrocast listeners on where things are this morning. And your view, Markets Policy Partners view, is that this is part of the toing and froing of this legislation, and we will get to we are still going to get to substantial spending in both of these areas, if not the same number on the reconciliation. But that's where you still are.
Yeah, I think so. Go ahead, John. But it basically, because you're shooting yourself in the foot if you don't pass this stuff.
Yeah, that's the bottom line. And clearly the moderates are trying to get probably some pull. There are only 9 of them. The Progressive Caucus is bigger and is probably, 9 is, as you say, a pretty solid number. They have a 3-seat majority. And the question really is, now can Speaker Pelosi bring something to the table that convinces them to go along, and whether what do they need to have? Is there something else that is behind this that they can compromise on and get a little something more to bring home? That's really the question. We've had the House moderates pushing for the SALT cap removal and other aspects. There's obviously been fracture and division. The Progressive Caucus has stayed pretty in line with the Biden administration, but it's going to be a real test of Speaker Pelosi's deal-making abilities, and we're not in a position where we would bet against her. Especially when you have a very effective White House outreach under President Biden, who is, I think he's very adept. He's of the Hill. He knows that world, and he is certainly not shy about wading in on this. This is, as Brendan said, simply a must-have for the Democrats. It's a delicately choreographed procedure going forward, but we think that there's going to be ultimately a resolution, whether it is the exact kind of numbers that we have right now. We doubt that it's going to.
And just to clarify, both are a must-have. You can't have the Republicans agree to a bipartisan infrastructure deal and not pass it. Once you pass that, you also have to then pass your own that has the priorities of your party in it.
Yeah, that would be shocking. I mean,
look, and the pay-fors are all in the follow-on bill, and there's clearly a lot of there's a lot of back and forth here, and it's hard to imagine that the Democrats in the House would blow this whole thing up without basically in a way that just would simply torpedo the Biden administration. I think this is really
and maybe torpedo. Yeah, and torpedo their, the party themselves. Look, I don't. There's no question that this has elevated, it has lowered the likelihood that both of these things get done. Has it lowered it enough that we still would say it's not, odds on that they both get done? No, but it has added a level of uncertainty that they might not get done. And it's a game of chicken, and either the House progressives or the House moderates are going to have to blink. Or find some kind of negotiated solution. And it's not obvious where the saddle point is for that kind of agreement between them right now. But maybe, they go home for a hot summer and come back, and maybe they find some solutions in September. But in terms of, why we all feel so strongly that both of these bills will substantially get done, even if the number is smaller in reconciliation, is that, I don't know what the chances are of the House keeping, of Democrats keeping the House and Senate if they pass both of these bills.
Right.
I'm pretty certain I know what their chances are if they don't pass these bills.
It's zero.
Zero. Yeah. All right. Let's get to other more, the things that we planned to come and talk about today. I think we were hoping to.
And I'm not necessarily
by the construction bill today. Yeah.
I'm not a political genius, but I do know that most elected officials tend to like to get re-elected.
Base case, right? Base case. That's our base case. They want to get re-elected. Yeah. They don't, in China, they don't deal with elections quite the same.
Yeah, she gave up on those. What was it, 5 years ago?
Right. Yeah, she isn't out running for re-election, but he is certainly exerting his control over the economy, and it is having significant economic consequences for their markets, for their companies. For their long-term economic outlook, for the relationship between the United States and China, which we should note, I think today or this week marks the 1 year anniversary of the close of the China-U.S. agreement. They were supposed to have had meetings. The formal close every 6 months. There have been no meetings to talk about the next phase and to assess the first phase. The first phase has not gone really well, albeit with a COVID intervening. A lot of the tariffs remain in place. It doesn't seem like any kind of trade discussions are on the horizon. There are discussions on other issues, but not so much on trade. And at the same time, you have the Chinese leadership that is really laying strong hands on its technology companies in particular, but also companies like, they've basically turned the entire tutoring business in China into a nonprofit. And in the case of at least one company, Wall Street Education, the China company of Wall Street Education, which is a language learning company that if you're around, China, Beijing, Shanghai, you see them all around. They teach business English to Chinese people. Very successful company. But it appears it's going to be entering bankruptcy here pretty soon.
And even yesterday, they went after the insurance sector. So really, basically, it's any company that has any sort of influence on its citizenry.
Yeah, Beijing is obviously conducting a massive campaign against its own private sector.
Yeah,
and this is something that fits into the narrative that the U.S. regulators and the Biden administration, the Trump administration before them, have put forward about China, that this is a place where investing in Chinese assets is fraught with risk, given the fact that these companies have no enforceable property rights in their home market, aside from what the Chinese Communist Party decides to grant them on any given day. And this is something that, the regulators in the U.S. had come at the China question. This is a longstanding issue. U.S.-China relations deteriorated under President Trump, but that the frictions were growing even before that. There was a lot of loss of momentum of the so-called convergence thesis, as President Xi canceled the term limits, and it became pretty clear that the longstanding belief in Washington, D.C. that had animated a lot of these policies, which was the richer China gets, the more they will become like us and absorb Western values and become responsible stakeholders in the global, in the global community, and more democratic, more capitalistic, and so forth. And that argument has been completely lost over the last few years. We expected the Trump administration to be tough on China, and they certainly followed through on that. But we'd had a longstanding call that the Biden administration was going to be just as tough, if not tougher, on Beijing, and that's really borne out. We've seen a change in prioritization of where to push on China. We've seen a different style, obviously, but the Biden administration is in some ways really much more, fundamentally opposed to a lot of what China does. The humanitarian aspects, the Trump administration obviously acted on that front, but it was pretty clear that President Trump wasn't as emotive an issue for him. He was far more focused on the trade side. The Biden administration has a lot of wherewithal in the multilateral space that the Trump administration didn't have to marshal our allies to counter China's rise on various fronts. It's a very, it's a trend that takes you into some very challenging places if you extrapolate. But what we didn't expect was Beijing to basically make the argument for the U.S. regulators. And
in a way, I have to say, I think that's, so that's a view, right? Is that, the big is bad argument, but I think there's a distinctly different character to what the Chinese are doing. And I have my problems with the anti-big, antitrust bent of now, the Biden administration, right now where the FTC and DOJ are going on these issues. I actually think these companies have been really, we apparently have 5 giant monopolies who all fight and fiercely compete with each other, which sounds like a contradiction in terms. And I would assert that, in fact, it is a contradiction in terms. Let's just set that aside for a second. They do have U.S. regulators are
also, all those companies are basically give their stuff away for free also.
Yeah. The U.S. regulators are I do believe them that they are interested in competition, that I do believe that is the inspiration for their activity when they look at U.S. Technology companies and others. I do believe that's their inspiration. I think the Chinese we welcome the language on competition, but what they're really after is the concern that these companies are becoming or threaten to becoming global, large, and non-Chinese. They become global companies and not Chinese companies anymore that they can control. And so I would just say that the thesis of going back 20 and 25 years ago that as China has market, leans into a market economy, creates companies that act, in healthy capitalism and grow and try to compete for market share and customers. They're going to become better companies, and they're going to find out that living that way, operating your business that way is more conducive with liberal democratic institutions than it is with communism. I actually think what we're seeing right now is evidence of that. This is exactly what the Chinese are seeing. They're worried that Alibaba and Ant and TikTok and Didi and all these other companies are becoming more like their global and Western competitors than Chinese. And they are going to have to, as companies operating that way, going to have to make, treat data different ways and treat property different ways. And this is a threat to the Chinese regime. The other thing that happened this week, the Chinese did, is that they've signaled they're going to be eliminating certain karaoke songs that can be played in karaoke bars in China. Right? There are going to be songs that you are not allowed to sing at karaoke bars in China. This is a heavy-handed state. That has nothing to do with, or a heavy-handed regime. That has nothing to do with competition. They're not worried about the competition for songs. They're worried about what you're thinking and what is influencing the way you think about, your economic situation, your political and cultural life. And that's a distinctly different thing, I think.
Yeah, there's a lot of commentary saying Beijing is going to rue the day they did this to their private sector. They are strangling the golden goose, and what made them successful over the last few years, over the last few decades, really, and infused the regimes prior to Xi with validity and with power, really was economic growth, and they don't have a source of legitimacy that really can compete with that. Well, President Xi's source of legitimacy is very much nationalism. And, there was an understanding, obviously, when President Xi came in, that the breakneck growth, that just isn't sustainable for the long term. And so another source of legitimacy that they're focused on is clearly that, the geostrategic competition. And one of the kind of classic tropes about China in the world, at least in the modern world, is that modern China has a hard time projecting its power abroad because it spends so much of its resources and energy holding itself together. Yep. And that the typical data that people trot out is the spending on internal mainland security versus the standing army and navy and that sort of stuff. It's wildly disproportionate, at least in the estimates of the data that people can find.
Seems that way. Yeah.
Yeah. And so this is another example of that in the economic sphere, where the difficulty of the internal contradiction of keeping those Chinese companies on side with regard to the Chinese Communist Party at home really is an impingement on their activities overseas. And so they're caught between a rock and a hard place, with Washington and Beijing both squeezing them. It's a challenging situation, but I think the most troubling thing is when you do extrapolate, if you do draw the dotted line of these trends, where does it go? And it's going, pretty rapidly in a very challenging and decoupling direction. That's problematic and certainly infused with risk. For the
that's a question I have for you on this too, and for both of you guys on this is that, sort of our instinct is we look at it and we say, these companies, if you're thinking about the profitability of these companies going forward, you might say, well, that's going to stunt their growth. They're not going to be as profitable over time. At the same time, they're in a giant market. If you are Didi, will you stop being successful if you only focus on China and maybe a couple of other countries? Like, will you cease to be a really successful company? I mean, you can keep that going for a pretty long time. A lot of these companies can keep it going for a very, very long time.
Yeah, it's a really interesting point. Like, I think Ant Financial is a good example. Ant Financial is really a one-stop financial shop. You can get insurance, you can get payments, you can get banking.
Super app.
It's a super app. Yeah. But on the flip side, all of that information is something that a totalitarian communist government would love to have. So Ant Financial will be really successful just within China, but it's really just going to be a state-run financial app, and you're signing up to let the government know literally everything that you're doing 24 hours a day.
And some of the other factors, when we talk about risks, Chinese China-centric risks to the global economy and the global financial system. We also talk about the legacy debt issues that are most prominently featured in Evergrande, the highly levered property developer, and Huarong, the state-run bad asset management company. And they're in the Huarong is obviously, in line for a bailout of some kind, but nobody knows really to what degree. And there are a lot of questions about Evergrande. They've managed to keep pulling rabbits out of hats whenever they have big debt rollovers and so forth. But their assets are trading at very stressed levels, and it's a concerning situation. The other aspect that we bring up is Hong Kong. Hong Kong is increasingly turning into just another Chinese city. The magic of Hong Kong wasn't just that it was a really cool city with great food and amazing entrepreneurial spirit, and it was because that was infused with a rule of law that you could depend upon. That is not the case, or increasingly not the case anymore. And
so much of Hong Kong is financial firms, which can just move to Singapore overnight,
And we think about the decision making of foreign corporate entities, and if you're going to be choosing to locate your business or to where to deploy resources, is Hong Kong? How does it compete with a place like Shanghai? And
exactly, I won't go to Hong Kong just for business or pleasure because I don't trust it. Let alone set up a business there. Good God,
it's now very it's blurring the distinction, but it was quite clear, what kind of resources as a foreign entity you would put in Shanghai or Beijing versus what you would put in Hong Kong, and it's certainly not nearly as clearly delineated anymore.
Well, I think we're going to keep track of these movements in China, and we're going to have to pay attention on how they shake out, because I do think it's a big,
and that's what we kind of joke about. Like if you're not exactly sure what the Chinese government's intent is, just ask them.
Yeah,
we're not hiding it anymore,
Yep. In the markets, obviously Chinese equities have been underperforming very dramatically this year. They've had a little bit of a bounce as the People's Bank of China shifted to an easing posture recently, just as most of the rest of the global central banks are going the other way. This is not a particularly encouraging sign. And the stock markets have been really taking a beating this year. But we're looking at the renminbi, and that is where, if China is going to be engaging in a further deterioration of growth under this regulatory barrage from Beijing, plus the Delta variant, plus just the organic slowdown that they've had coming in train, we think it'll manifest in the renminbi. So we're watching that very closely.
It's definitely worth paying attention to. That's where I'd be looking. All right, guys. Let's speaking of values, currency values, in a way, we'll transition to inflation when we come back after the break. We got a few clues on where inflation is heading. We'll come back. You're listening to the Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter at marketspolicy.
All right, we're back on the Macrocast. Brendan, we got some insights into inflation this week. What do the numbers say?
Yeah, so we got the consumer price index and also the producer price index. So the consumer is what we as consumers spend, and the producer price index is what companies, how much their prices go up. So we had a little bit of, it was kind of in line, but the consumer price index is starting to moderate. So a lot of the individual components that make up the CPI that were hugely affected by the pandemic, like used car prices and things like that, those are moderating, which is having not a deflationary effect on the CPI, but it's kind of going back to more normal rates. So the inflation rate is still 5.4%, on the headline, and then the core, which we strip out the gasoline prices, that's at 4.3%. So this was a little bit of a tip of its cap to the Fed, and especially Chair Powell, who has argued that these prices are transitory, and it's because we locked down the economy and reopened, we're going to have a spike, and then it's going to go back to more normal settings. So, but with this, we also had a little bit of debate this week within the FOMC, not just the FOMC, but all the regional bank presidents. There is becoming a little more growing chorus that would like to see the Fed begin its taper of its balance sheet in September, where Powell and kind of the core of the FOMC has indicated that they would much rather see how the September and the October jobs report look because that's when we're going back to school, hopefully. That's when we're going back to work, hopefully. So Powell's kind of argument is, why rush it for a month or two and screw this whole thing up? Let's just make sure that we really are back to the projections that we have in our outlook. But the inflation component of this is helping Powell's argument.
One of the things that we've seen is that the market indicators of inflation concerns, tips break-evens, and so forth have been very tame. Those peaked out in May and have come down very comfortably below the levels that we saw then. We're at levels that are above 2% for the 10-year break-even, but only modestly, and that's not necessarily out of line with the Fed's revised inflation mandate, which is much more permissive of modest overshooting, and even the 5-year break-even, which is a little bit higher, is still below 2.5% or around there. These are pretty comfortable levels and not particularly concerning. They haven't been trending higher. And we're going to see some data on inflationary expectations in the University of Michigan Consumer Survey today. So that'll be interesting. So the sensibility about inflation concerns in financial markets has really come off the boil here, and the attention has shifted toward growth concerns because of the Delta variant spread.
Yeah.
However, there are still that's not to be dismissive of the price pressures that we're seeing. We're talking with our infrastructure industry specialist, Norman Anderson, who did such a great job explaining the state of play in that industry to us on a previous podcast. He is noting that this is a low margin business and the input costs are high, and it is really threatening the viability of some of the projects in the current arrangements that they have. That's a very significant issue, and the input prices, as we saw this week, are still surprising to the upside, and that means a margin squeeze. And so the economic consequences of that, if that continues, are certainly worth monitoring.
Well, we will be doing that. I mean, I think everyone will be monitoring it pretty tightly over this month and the next couple months. It's one of those things where we told you a storm was coming. The storm is a little bit stronger than we thought it would be, but we're in it. And it's kind of hard to assess it when you're in the middle of it. You don't know how long it's going to go, and how if you were wrong about the depth and strength of it, will you be wrong about the duration of it as well? And we don't know that. We have guesses on it. We have assessments based on what we're seeing in different parts of what factors into pricing pressure, but we don't really know yet. And I think a little more information over the next couple of months will help a lot. All right, guys, let's take a break and come back and look ahead to next week. You're listening to the Macrocast.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The HPS Civic Science Economic Sentiment Index accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
All right, back on the Macrocast. Hey guys, one of the things that we didn't get a chance to get into much today, but we definitely want to come back and talk about it next week, is talking about oil and OPEC, and Biden administration sent a letter out encouraging them to continue production, which caused all kinds of whirlwind attacks and recriminations from different quarters. But it just very quickly, what do we have on? I mean, what's going on here with this encouragement?
Yeah, it seems like OPEC is now getting leaned on by the Biden administration at a time when they're obviously having a more difficult, a bigger challenge keeping the cartel members together and in line. We saw the UAE break ranks with Saudi and push for increased production for themselves, basically around their own baseline. It was the Saudis ended up conceding. I think that this is, as the pandemic progresses, these supply curbs are going to have a harder time, being palatable to a lot of OPEC members at a time when, we don't know the trajectory of growth. There are competing views on demand that have come out this week between the OPEC itself and the International Energy Agency, which was significantly less optimistic than the OPEC projections. There's a lot going on. But while there's a lot going on, oil prices have remained really pretty steady. And so there's been some chop, but right now oil prices aren't playing along with the inflationary narrative in the way that some of the other commodity prices have.
Well, we'll spend a little bit more time diving into that more deeply as we go forward. I think there's a lot to look at there. Brandon, what's the data look like for next week?
So U.S. retail sales will probably be the biggest data point, especially with back to school shopping, and most of the country now goes back to school like in early August, all the South and everything, which I think is because football related, but. In the Northeast, we go back in the end of August, early September. Then on the central bank front, we'll get the meeting, the minutes of the Fed's July meeting, which will be important because at that they kind of indicated that they're not planning on doing tapering at September. So we'll see what kind of message they want to convey to the market in those meetings minutes. And then we get the Reserve Bank of Australia, and also, as we were talking about earlier, the People's Bank of China will have interest rate decisions. So especially the Chinese will be a big deal. But also the RBA has been a little bit more of a tightening. But they've had to lock down again because of the Delta variant. So we'll see what their message is.
Yeah, it's been a strange time for them in Australia right now. New Zealand seems to be faring better, but the Aussies are in a tough place.
Yeah.
Still with super low vaccination rates.
I just saw it's 37% in Australia.
Yeah.
They just don't have much vaccine.
We'll have a lot to talk about next week. Thanks for the show this week. Have a great weekend, and we'll be back on the Macrocast next Friday.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.